So the other day, I was walking around without any clothes on, reading some of your guys' comments and questions that you had for me, and this one just stood out, and I thought I'd share it with the class. Do you mind? I think we might be able to get something out of this together. Hey Zach, I'm a 36-year-old investor trying to set up my retirement accounts for my wife and I. I noticed her 401k is performing significantly better than mine, and I wanted to take advantage of the same stocks as she is in, but don't see a similar option. Also, I have been invested in a fund in my IRA for a couple of years now, and it is not performing as well as I had hoped. What do you look for when determining what to invest in? Your insight is always appreciated. Well, thank you, Charles. He's not Charles, but we're going to call him Charles for this video. So what do I look for there? So there are a lot of things to unpack here. So guys, get your popcorn, get your pencil and paper out. And the reason I say pencil is you're going to need to scratch a bunch of things out and erase it because we're going to make some mistakes as we go along here. And again, up front, I'm no longer a financial advisor. I'm no longer a broker. Everything I say here is just for entertainment, informational purposes only. Make sure you talk to someone who is licensed and actually knows what they're doing. All of those things being said, what do I look for? What's going on here? So to start with, the 401k plans. Unfortunately, you're not going to have a ton of options there. Generally speaking, the average you're looking at in an investment account through a company, so a 401k plan in this case, you're looking at around 20 to 25, maybe 30 plus investments. So usually it's around 20. You're going to have 20 investment options, plus or minus. I've seen some as little as 6 options, maybe 4, I think I've seen. Like really, really low, and I've seen some as high as in the 50s. Some of those overlap a lot, and there are a bunch of target date funds that do the same thing. But long story short, you're going to be limited with your 401k plans, and your plan administrator, the person who picks out the funds that are going to be available in your 401k plan, it's up to their discretion. They can choose whatever they want for that plan if they work with and sit down with Charles Schwab, Fidelity, Vanguard, Merrill Lynch, whoever. It doesn't matter. Whenever they sit down with those banks, they're going to say, hey, this package right here is X dollar amount. This one's a little bit more expensive. You're going to have some more flexibility with this one. A lot of times they just go with the cheaper package. And to be honest, most of the plan administrators, they know just enough to be really stupid when it comes to picking out what kind of options that you get to choose for your retirement. And it totally sucks. And you don't have any control over that. That being said, here's the great part. Anyone can go and open up an IRA, and you will have literally thousands of options. It's beautiful, especially if you don't have a match in your 401k plan. Unless you get some really good deals on like some company's stock or whatever the case, if you don't get a great advantage out of investing in your 401k plans, a lot of times I tell people to just skip it. That's what I did tell people. I'm not telling you to do that. It may or may not make sense depending on your goals and whatever you and your wife have set up and whatever your risk tolerance is. There are a bunch of things that you're going to want to consider. All of that being said, okay, well, my wife's invested in the XYZ fund. That's great. Apparently, you don't have the XYZ fund as an option. And just because it's been doing great for a couple of years or a couple of months or however long it's been, does not mean that it's going to be doing that in the future. One thing that I like to look at with funds, what do I do to determine how much I want to invest in this fund or what makes this fund better than this fund, in my opinion? Whenever I was talking to very, very smart individuals, it didn't matter how much money they had. It all came down to the same thing. How much risk tolerance do you have? It may make more sense for someone who can't stomach a lot of risk to invest a little bit more heavily into bonds. Now, past performance would tell us that stocks will outperform those bonds, but if you literally won't be able to sleep at night, or you will always be checking out your IRAs or whatever plans, that's something that you're going to want to consider. You're going to want to have a long sit down with the wifey woo there, Charles, and you're going to want to think about these things. Okay, well, I'm okay with my account going up and down and really down in between now and the time that I retire. If you're 35, 36, however old you are, you've got a long time till retirement, probably. If you're going to retire around 60 years old, you've got a long time, my dude. Personally, I like to invest in stocks over bonds, especially at that age. When you get closer to retirement, we can talk about bonds and cash and putting your money into REITs and this and that, and that's all fantastic. One of the biggest things I like to look at would be, what's my risk tolerance? Next thing I would like to look at would be the expense ratio as well. Well, what's an expense ratio? And then there's the style box. An expense ratio, is calculated by dividing a fund's operating expenses. And then, so after you do that, so you divide a fund's operating expenses by the average dollar value of the assets under management. Okay, well, what does that mean? Essentially, that's how much it costs you to have your money parked in that particular fund. That's one big piece that I like to look at. If you've got a really high expense ratio, that's no bueno for you, short or long term, if it's going to be more expensive, if it's going to eat into your returns. Now, a lot of times too, I see people who stress way too much about expense ratio. Although it is an important thing to keep in mind, it is not the end all be all of an investment. A good investment is a good investment at the end of the day, if you see good returns. Another thing that I like to look at for a fund as well, that's great, it's done great the last couple of years, or if it's done terrible the last couple of years, that's not a red flag to me necessarily. It depends on whatever that particular company is, or if you're in a mutual fund, whatever the companies are that are in that mutual fund, these are all things that you're going to want to consider that, hey, does this round out my portfolio? This section right here. Okay, well, I've got a ton of money in this. I might want to shift some of that over here. So when there's just so much to throw out here just because I don't know the full story. And there's so many questions that I'd want to ask you, but to keep it general for everyone here who's watching this so you all can take something away from this, hopefully, would be, let's look at what this particular stock or mutual fund has done since its inception date. So when the fund actually came out into existence. Oh, it came out in 2015. That's not a ton of data. Oh, it came out in 2011. Oh, it came out in 1983. Great, I've got a lot more data to work off of here now. Wow, since 1983 up until now, with everything included in there, wow, I'm looking at about an 8.9% yield. That's what it's done. Fantastic, that's pretty good. Oh my goodness, this other one's done 11.1. That's really good. It's the same type of investment. Wow, this is a large cap fund. So, oh my goodness, there's just so much that we can throw out here. So I like to diversify, number one, but a big thing that I like to look at, what's the expense ratio? How much does it cost me there? What has it done since its inception? How old is it? The older the fund, generally, the better. Now, there are some great funds that you could be missing out on if you're only looking at super duper old funds, right? So for example, if you're looking for 50-year-old stocks, you're going to be missing out on Amazon and Apple and all these wonderful new stocks that are really the backbone of the S&P 500. Whether you like them or not, they're here to stay, at least for now. So yes, I like to put some money in there. Yes, I like to put some money in some older stocks. The biggest thing is, what has it done since its inception? Who is the manager of that fund or managers? Is it an active managed fund? History would tell us that active managed mutual funds do not outperform the S&P 500 after you factor in fees. Say what? Active managed mutual funds do not outperform the S&P 500. So if you just put your money in the S&P 500, just leave it there and don't pay someone to manage it for you, you'll actually do better. So a bunch of wonderful things that would be something that you could potentially take away from on this. So there are just so many things we can get into. And again, the style box, I touched on that earlier. The style box will tell you, hey, is this a large cap fund? Meaning large capitalization companies like the Amazons, like the Alphabets, the Googles. So that is what the style box is for. You can see, hey, is this a large growth kind of style box here? So is this a large blend? So which tells you there's going to be more bonds than that. There are just so many things that we can cover on this. I don't want to get into all the bips and dips and slips and nips and all of those wonderful things in this video, but we can do that next time. If you guys have any particular questions around that, please let me know. But that's generally what I like to look for would be, hey, do you want a 60-40 stock bond split? Do you want 90-10? Do you want 100% in stocks? Do you want some money in REITs? Do you want some money in tech? Whatever the case. So a lot of it comes down to personal goals, how much cash you want on hand. So it really just depends, my man. I don't mean to keep it too vague here, but hopefully that was specific enough to give you guys an idea. And maybe we can do some rate my portfolio videos as well, because that is not investment advice. I mean, isn't that really interesting? It's really intriguing because it's funny. I see a lot of videos on YouTube that have like little disclaimers in the bottom of their videos. You know, this is not investment advice, and then they like give investment advice, or they're like, you know, this isn't investment advice, and it's not even in the realm of them having to worry about it actually being investment advice. And yes, I say a lot of people that they're not lawyers, they're not SEC attorneys. Fortunately, I was friends with SEC attorneys, and whenever you go to take these tests, you have to know what is legal and what is not, what you're allowed to say and what you're not allowed to say. So I'm very familiar with walking that kind of line. So if you guys want to do a Rate My Portfolio, if you guys have some specific questions about, hey, here's what I'm invested in, what do you think? Again, I won't be able to say, hey, you need to move your money into here, you need to do that. I can't do that anymore. But what I can say is, you know, looking at this, here's what I think. Here's what I would do. That's some really interesting stuff, and I think it's a lot of fun. Maybe we can do a live stream of that sometime, a live Rate My Portfolio, or we can just do a video where you guys come at me with questions. Whatever the case there, if you guys did find this somewhat informative, or even if you got nothing out of this at all, I've got nothing to offer you, apparently. Make sure you subscribe and hit the notification bell. Watch another one of my videos. Thanks so much for watching, and until next time. Hey, Zach, how much do you weigh? Not as much as your mom. Oh!